We have broad contours of what policy looks like, but we can't score anything. What I can say is the CBO scores the Job Cuts and Tax Act of 2017 as losing revenue, which I don't believe. I don't believe that's the case. I don't believe the CBO is doing enough dynamic scoring. If we look at their estimates back in 2016 and what they assumed, the TICJA, as it was sort of known on the Hill, what that would produce in revenues, their revenue estimates were well short of what actually turned out to be the case, especially on the corporate side where revenues were actually quite strong. So we need to eventually, we'll get more details and we'll see how things play out, but I'd be careful on scoring this because right now we're not that detailed yet.
Well, understood on scoring. And voters are trying to make decisions based on the limited information they have here. And a lot of the analysis that we're hearing is that while Donald Trump seems to be considered more friendly to Wall Street, his idea to make permanent the tax cuts and add the tariffs would have a more inflationary impact than what Kamala Harris, the Democrat, is proposing in this case. Is that wrong?
I don't. The thing is, the problem is that everybody looks at these different proposals in isolation. You have to look at lower corporate tax rates, less regulation, permanency of tax cuts, much cheaper energy costs, an intention to onshore and reindustrialize, all as a comprehensive package. You can't just look at one in isolation and say this is inflationary and this isn't. What I could tell you is on the energy side, in terms of lifting energy production, to be a real commitment to expand energy production and get energy costs significantly lower. If we want to do a simple inflation adjustment, I could tell you that the energy share of the economy is almost twice the import share of the economy. So again, if you get those lower energy costs, you would offset any tariff impact. And by the way, as the president said yesterday, these things are open for negotiation. That's why the specificity at this point, I think, is premature. It's a transactional approach, basically, to help U.S. manufacturing and jobs. And you either may believe that theory or you may not. But I think it's very, it all holds together when you look at it in its totality and not just break apart simple pieces.
So if we want to focus on energy here specifically, if there were a blanket tariffs on all imports into the United States, that too would impact energy, right, and could result in higher energy costs. I'm sure you're going to say that Donald Trump wants America to produce more, to be energy independent, but we're already pumping a record amount of oil and gas because these are companies that like to exercise capital discipline and are returning a lot to shareholders. Is that what you think is going to change here?
I just want to change one thing you said. The thing is, we have increased production, but you have to keep in mind that to keep low and stable energy costs in place, you have to have long-term capital investment. So the intention is to do things that will improve the energy platform in a way that it's sustainably producing cheap, low-cost energy, which we had under the Trump administration, if you look at where energy costs were and if you look at where inflation was. So I think the plan is very comprehensive and it makes sense when it's looked at in totality.
We're looking at WTI crude oil below $68 a barrel in the futures market here. Joe, where should that be?
I mean, the market is pretty efficient. I think part of the reason the oil markets and energy markets are soft right now is growth. I'm very downbeat on growth.
Yes.
I was listening to Michael McKee talk about the data. I looked at the data today as being very soft. If we look at the private sector, excluding healthcare, because healthcare is very interconnected, intertwined with government policy, the last 3 months we haven't even generated 40,000 private sector jobs. The unemployment rate did tick down 0.03. In August, but temporary hiring fell again. Manufacturing was weak. One of the areas of strength was in construction, but it seems to me that's ripe for a major pullback in light of the big drop in construction openings and the fact that construction activity is extraordinarily soft. We look at home sales or look at pending home sales or starts, permits, builder sentiment, all those things suggest to us that the construction industry could shed upwards of 1 million workers, which by itself would push the unemployment rate up near 5%.
Well, that certainly would be something. 4.2% is where we sat as of today's figures. As you talk about construction and housing specifically, of course, we know a lot of that has to do with just where interest rates are in Federal Reserve policy. Donald Trump has suggested, including in an interview on Bloomberg Business Week, and he's doubled down on it a few times now, that he does think the Fed should have input when it comes to monetary policy. What would that look like if the U.S. central bank wasn't fully independent of politics?
Well, the Fed is an independent institution, but that doesn't mean the Fed is immune or should be immune from people criticizing it both on a constructive basis. We know that in 2018, and I argued this when I had nothing to do with the administration, that policy was too tight, and the president agreed, and the Fed wound up cutting because the Fed was too tight. One of the reasons why monetary policy is tight is because inflation's been high, and the Fed has reacted to that by keeping rates elevated. I think rates will come down, rates need to come down, but that's because I believe the economy is fundamentally soft. We've had basically every month, almost every month in the last 3 years, we've had the index leading indicators negative. This week we saw industrial production in the ISM at its lowest level since pre-COVID. So yes, signals are mixed, but unfortunately, they get mixed at turning points. And the revisions in the data are very important because revisions in the data often tell us about the underlying momentum in the economy. And the revisions we had that we learned about a few weeks ago, the 800,000 plus, my analysis suggests it'll be closer to 1 million, but importantly, these current revisions do not pick that up. So we could easily learn a year or so from now that if we're not in recession, we're very close to one, and that ultimately will bring rates down, which is a good thing. But I think the comment on policy being restrictive, I think I don't have a problem with that.
Yeah, we could learn that this was a very different summer than we thought when it comes to the job market here, Joe. So a lot of people say 50 basis points. Let's get to it. The Fed's late. But you also know as well as I do that we're going to hear a loud cry that day that a cut of that magnitude at this time is politically motivated. What will you say?
Look, I can be critical of the Fed, and I do it in a constructive way, and I think the president has as well. What I could tell you is Jay Powell did market easing back in December, and then went on 60 Minutes, somewhat similar to Ben Bernanke, and talked about the need eventually to lower rates from a restrictive level. I was a little bit surprised at the pivot in June when the Fed had 3 cuts. They went to 1, and then by July they were talking about maybe cutting at that meeting. At least several members were. But I think they've laid the groundwork for rate cuts. I do think the economy is soft. I'm not sure whether 50 or 25 is going to make a huge difference in terms of the longer-term outlook, and I don't think it really necessarily plays into the politics because, as you yourself have suggested, economists are debating whether it's 25 or 50. So I don't see this really as being a political decision.
All right. Well, that's fair enough. And as we've said, the Fed has made it very clear it prefers to make these decisions independent of politics. As we consider, though, the idea that monetary policy does have a lagged effect on the way it tightens and on the way it eases, regardless of whether or not Donald Trump or Kamala Harris wins, what kind of economy do you expect they will inherit in January based on how much policy has eased and to what extent that has actually influenced economic outcomes?
That's an excellent question because it's not clear we're in recession, and we may avoid recession if the Fed starts cutting and equity markets can get excited about the future. I'll leave it to the markets to decide what it thinks is going to be better for policy. Clearly, I'm familiar with the president's economic policies and think from a supply side, capital formation, productivity enhancing, household income and wage boosting phenomenon that his policies will work much better than the alternative. But to be honest, I don't know what Vice President's economic policies are at this point. We've got little bits and pieces. She'll have to describe it. But the economy will be influenced by what happens in November, and we'll see what happens. I do think in the short term things are soft. I hope we avoid recession, but we'll see.